What happens to the housing market during a recession? Today, I'm going to be explaining that very question. It may save you thousands if you can anticipate and understand what happens during a crash. I spent nearly 20 years in the real estate industry and went through many different cycles. I like to share my research with you. I'll boil it down to 6 key points to watch out for so you can protect your investments even in uncertain times. You might be asking right now, how do I know if we are in a recession? Here are the first signs of trouble. When the housing market crashes, one of the first things that can happen is a sharp drop in values. This means your property might not be worth as much as it was before. For example, let's look at a real-world situation. A property purchased in 2021 in Mississauga, Ontario, lost $600,000 in 2024, according to Splitters, a private wealth advisor for CFP. Imagine seeing that much money disappear from the value of your home. It can be a huge financial blow for any owner or investor. But there's more. You might end up in a situation called negative equity. This means when you owe more on your mortgage than it's worth. For example, if you owe $450,000 on your mortgage and your house is now worth only $400,000, you have negative equity. This situation can be really hard to get out of, and it makes selling difficult without significant financial loss. What's worse is the long-term effect on generational wealth. Many people see their homes as investments that will grow in value over time, helping them save for retirement or pass something valuable to their kids. When property values crash, this plan can get wiped out. By understanding how equity works and identifying the loss in home values, it may be the first sign that a recession is coming. While equity is one thing, another important factor to look out for during a potential recession is what happens when property owners can no longer afford their payments. With values dropping, many people struggle to keep up with their mortgage payments. This is called mortgage default. It happens when someone can't pay their mortgage, and the bank may eventually take their home away. One of the big reasons this happens is because of rising interest rates. Many people have variable rate mortgages, which means their payments can go up when interest rate rises. If interest rates go up too much, property owners could suddenly find their payments unaffordable. On the other hand, people with fixed rate mortgages aren't safe from the pressure either. When the market crashes, they might face higher monthly payments when their mortgage renews. Look at this year. There are 1.2 million mortgages coming up for renewal according to CMHC. That's going to be a lot of people that will be paying more monthly for housing, as mortgage terms are typically 5 years long. Back in 2020, mortgage rates were a lot lower compared to now. Plus, it will be harder to qualify for a new mortgage if they want to move or refinance, which leaves them stuck with their current situation. Mortgage defaults are slightly increasing. CMHC mentioned that mortgage delinquencies rate across the country grew to 0.192% in the second quarter of 2024, representing roughly 13,000 households who are late on their payments by 90 days or more, up from 0.188% in the first quarter. In 2022, the rate reached a record low of 0.14%. Banks might offer temporary relief like extending the length of the loan, but that just means owners will be paying for longer. While this can ease the pain for a little while, it doesn't solve the problem in the long run. So if there are more defaults than compared to the historical data, a recession may be around the corner. But this next point is perhaps the most disregarded of them all, and yet it is the one that drives most of the economy's decision: the banks. How do banks and lenders survive when the market crashes? When property owners start defaulting on their mortgages, it doesn't just affect them, it affects the entire financial system. Banks and lenders face big problems during the housing market crash. When too many people cannot pay their mortgages, the banks lose a lot of money. This makes them less willing to lend money to other people, which makes it harder for everyone to buy a house. Another problem is with mortgage-backed securities. These are investments made by banks and other investors, where they buy and sell pieces of mortgages. When too many people default, these investments lose value, which can cause big financial losses. Have you seen the film The Big Short? So it's not just the property owners who are affected, it's the banks, investors, and even regular people like you and I who may have money tied up in these financial products. As the banks lose money, they may start to restrict lending. Fewer people will be able to buy homes or get loans. This slows down the economy even more and adds to the overall crisis. Here's what the Bank of Canada says. If the system isn't working well, people have a hard time getting access to the money they need. This can weaken the economy. Although it doesn't happen often, sometimes things can go really badly. So pay attention, because if the banks start to lose money, it could be a quick downward spiral effect into a crash. At this point, you might think to yourself, how will this recession affect me on an individual level? I have a secret to share. A housing crash doesn't just hurt property owners. It can shake up the entire economy, as I previously mentioned. But how does it affect everyone? When properties lose value, people start feeling less confident about their financial future. This leads to lower consumer spending. If people aren't spending money on things like cars, clothes, or even vacations, businesses start to struggle. As businesses face slow sales, they might have to cut jobs or reduce hours, which cause higher unemployment. When many workers lose their jobs, it makes the economy even weaker. Not only that, but the industries related to housing, such as real estate and construction, can face big problems. Builders may stop building new homes because there isn't enough demand. Real estate agents may struggle to sell properties because prices have dropped too much. This creates a snowball effect where more people lose their jobs and the economy keeps getting worse. With fewer people spending money and more people out of work, it can feel like the whole country is in a slump. That's why a housing crash isn't just within the real estate sector. It's a nationwide problem that affects everyone, whether they own a home or not. Ray Dalio, a hedge fund manager, made a video called How the Economic Machine Works. I suggest you watch it in order to understand why and how recession happens, so you can understand how it affects you on an individual level. The point is, if you see people spending less and unemployment rising, the economy may be going into a recession. Fortunately, according to Statistic Canada, unemployment remains unchanged at 6.6% in March 2025, and consumer spending is sluggish on discretionary goods, according to RBC Economics, when comparing the months of December and January. So keep an eye on the unemployment and spending levels, because it will have a direct impact on housing, as people may put a hold on that decision. However, if you are in the rental business, you need to really listen to this. As fewer people are able to buy properties, more people turn to renting. This creates a bigger demand for rental properties, meaning there are more people looking for places to live than there are housing available. Because so many people need to rent, rental prices can go up. This makes it harder for families and individuals to find an affordable place to live. Even if you're not buying a property, you might still feel the effects of a market crash through higher rent. At the same time, investors who own property might see an opportunity. With more people needing to rent, some investors and corporations might buy up more rental properties and take advantage of lower interest rates and property values. This could also lead to a rise in purpose-built rental properties like apartment buildings, where developers build places specifically for people to rent. While this could be a good thing for investors, it also means that rents could keep climbing. Rental demand stays high, and as people are squeezed out of property ownership, they might not have a choice but to pay higher rents. Luckily, in 2025, according to rentals.ca, an organization says that in Canada, the average asking price for all residential properties in January continued to fall for the fourth consecutive month to $2,100. This 4.4% decline marks an 18-month low. So, are we currently going into a recession because rent prices seem to have fallen? Knowing this information is critical when we are looking into a possible recession. Many people think that housing is a necessity and should not be treated like a business, as it's unethical. But who is the savior to lead us out of a potential mess? What measures could stabilize the market during a crash? A recession can hurt a lot of people, and the government often steps in to help. Governments don't want the economy to crash completely, so they take action to stabilize things and try to make the situation better for the economy as a whole. One of the first things the government might do is lower interest rates. This makes it cheaper for people to borrow money, which can help people buy properties or refinance their mortgages, as we have seen in recent months. When borrowing is cheaper, more people can afford loans. This can help bring some balance back to the housing market. This ultimately in return will stimulate spending as people will have more cash in their pockets. Another thing the government might do is to offer assistance to struggling property owners. This could be in the form of financial help or programs to make it easier for people to keep their properties. For example, look at the Canada Emergency Commercial Rent Assistance Program during the COVID era. Governments may also take steps to keep financial systems stable by injecting money into banks and lending institutions. This gives banks the funds they need to keep lending and prevent them from collapsing. Take a look at the 2012 article from the CBC titled "Banks Got $114 Billion from Governments During Recession." Finally, governments may create new rules or regulations to prevent another crash in the future. This could include stricter lending laws or new taxes on people who own many properties. Look at the new mortgage reforms that were implemented by the Government of Canada in December 2024. These changes help make sure the market doesn't become too risky again. Understanding how the government addresses a recession is important because you may be able to take advantage of their assistance that they offer. However, is their assistance enough to help each person? This next point addresses what you can do if you don't qualify for any government help. Remember, in a recession, property values drop, mortgage defaults rise, and even the economy starts to feel the effects. It's not just property owners who are affected. Renters, investors, and entire industries can feel the ripple effects. But don't worry, there are ways to protect yourself even during uncertain times. The first thing you can do is stay informed. Keep an eye on what's happening in the housing market and the economy. Be aware of your surroundings. If you're thinking about buying a home or investing in property, make sure you're ready for potential changes. It's also a good idea to talk to a financial advisor to make smart decisions about your money and investments. If you already own a home, it's important to make sure your mortgage is manageable. If you're worried about rising interest rates, consider refinancing or talking to your lender about options that could help you during tough times. Each person's situation is different. For me, I had to sit down and really think of what to do on my next move when I was stuck in a rut. You may need to restructure your debt. For example, over the past few years, I had to sell all my lower performing assets to pay for the more expensive loans as interest rates rose. Finally, remember that governments and banks can step in to help stabilize things. When things might seem uncertain now, the government often takes steps to keep things from getting worse, even though they may not be helping you directly. In the end, the economy will bounce back, but it will take time. Reflect on the points mentioned in this video and compare it to our current market situation to answer the question. By staying prepared and making smart choices, you can protect your investments and stay on track for the future. But by far, I think the most important factor is where you gather your information and data. Be sure you read and listen to reliable sources. I've been in an industry for some time now, and I've seen many things over the years. You can get a glimpse of what I went through too by watching how I went from nothing to 8 figures. That's it for now. Thanks for watching.